Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is a very special edition of Market Guru. Our Market Guru of the day is Mr. Charanjit Singh, Fund Manager, DSP Mutual Fund. He'll be joining us shortly. And this is a show which will help all our viewers really understand from these top market gurus' perspective as to what their thought process is about the current setup in the market, the way the market trajectory could be going forward from here, the key triggers and the factors that will be important for all you retail investors to keep in mind. Also, we will get to understand from him more about the mutual fund that he handles, the key holdings over there, the investment philosophy and the strategy, and therefore that could give you an idea as to what is the strategy with these top market gurus are really looking into the market as well. Warm welcome to you, Mr. Singh, and thank you so much for taking the time out for this discussion on Business Today Television. Just like how our thumb really says today, the big thing that all the viewers are interested to know is what next in the markets. We've seen a sharp one-way rally up until the budget, a consolidation in the last 4 days odd, but again, the markets have scaled up beyond 24,500 odd. The question is, has the market already peaked out ahead of the union budget, or is there much more to go? What would you say?
Yeah, so when we look at the markets, the run-up has been pretty sharp, and a lot of sectors, what we are seeing is that there are definitely excesses which are building up in terms of the valuations, and valuations have gone up, much ahead of their long-term averages. So there is definitely a thought process which market has that maybe the earnings growth at a higher level can sustain for a very long time, which could be a question mark, in the near term, whether the earnings actually come through for a lot of these, sectors like industrials and all. So that is what we have to continuously track. But I think from here on, definitely the street is watching out for one is the union budget, which could be one of the event. But beyond that, I think from a macro perspective, India is very well placed. We are seeing, good GDP growth rate numbers. We are seeing, from inflation perspective, the inflation is under control. And overall, the macro setup, from the government's focus on the infrastructure and capex spending, that continues to remain strong. So I think what could happen is from the market's perspective, there could be some, sideways movement for the near term as we get more clarity and the visibility going forward from the earnings perspective. And as the market, consolidates at this level, once we get more, visibility into the earnings growth going forward into the next financial year, I think that will be a further trigger to the market re-rating. Additionally, I would like to add is that the flows are continuously, very strong. And if you look at the SIP, monthly run rate is almost around 21,000 crores and continues to remain strong. FPI buying has already, started. And when I look at the, mutual fund perspective, also there's a fair bit of cash which is there, which has to be deployed. So I think all these factors are leading to, good kind of flow which is there in the market, which is also driving. So liquidity is one of the factors which has been driving the market significantly, apart from the, overall macro buoyancy which we are seeing.
Yeah. The other thing that I wanted to understand from you, Mr. Singh, is that the earnings season has kick-started with TCS coming out with the earnings more or less on the better side from expectations. What is your own sense of the earnings season this time around? Where do you think the outperformance and the underperformance could come in from, sir?
Yeah, so see the earnings season, what we are seeing is that consumption side had been, weak for a long time. Now, when we are looking at even from the budget's perspective, there's a, fair bit of push which is expected on the, consumption side, so that, the end markets, which are, entry level customer, which has not been there in the market, they come back into the market. So when you look at IT as a sector, it is more dependent on how the global, outlook is performing. When we are looking at some of those markets, now US is talking about the Fed rate cut, which is going to come in. So, and overall, what we are seeing is that the outlook from, some of these IT companies has been now turning around in terms of it has not been that bearish, and even the hiring has started. So I think overall, as the deal finalizations happens, the re-rating will start happening. Some of these are acting as more of a defensive sectors in a very volatile market, as we are seeing, a lot of global events panning out right now. So there's a allocation which has been increasing towards IT as well as, consumption sectors to actually offset, some of the volatility which could be there in the market. One, because of the expensive valuations, and secondly, because of these global issues, what we are seeing. Yeah.
Mr. Singh, the other question that a lot of viewers are now getting fearful about is after seeing a one-way run-up in these sectors like PSUs, defense, railways, shipping, for instance. How should one be really look at these? Should one continue to stay put? Those who have enjoyed this large part of the rally, there is other sector of the investors, segment of the investors which are feeling a FOMO because they have missed out on this remarkable one-way move, multi-bagger returns in just about few months perspective. How would you advise fresh investors who may be, all willing with a lot of cash in hands, blank checkbooks, that, we want to just participate in the markets even at this current level? What would you suggest?
So I think for the retail investors, it is to be, very cautious at this point of time. We should not be chasing these themes. Some of these stocks have run up way ahead of their, fundamentals, and the current, valuations are factoring in very high growth rates going on for, a decade or two. So I think that is not kind of sustainable as the reality will catch on and some of this liquidity factors, kind of weighed off. So that there will be definitely a sanity check which will come in. And like you rightly said, some of the sectors like maybe shipbuilders, the defense sector, the railway sector, these stocks actually earlier used to trade at a very low P multiples. There has been a significant P re-rating in these segments, and that we think has been driven by the factor that government has come up with very favorable policies to drive the overall outlook from the perspective of either defense imports getting banned, more manufacturing picking up in the Indian market. Even for the shipbuilding sector, there is a thought process from 2030 onwards. We should see more and more Indian manufactured, ships getting out there into the market. But I think still we have to be always be cautious about the valuations, not fall for the themes. I think it's a good time to even start looking at booking profits, so that whenever this liquidity kind of wave recedes, then we are not left in a scenario that we are losing all our profits what we have made. And definitely as the earnings will catch up, there'll be a reality check which will come in these segments, and definitely it will be a good thing to look at investing versus stock investing versus a mutual fund. So I think that makes more sense to manage your risk at this point of time.
Okay. Now coming to the upcoming budget, the biggest trigger that markets are probably penning their hopes on. What would you, as a fund manager, what would the markets overall have expectations from this upcoming budget? Is there anything that could steer the markets from the current levels even higher that could come in this budget? Your sense, sir?
Yeah, so see, one, if you look at, from this budget's perspective, government has got a good room because of the, RBI dividend, what they've got. So it means that they have the runway for investing or for putting money into some of the schemes in order to support the rural and the agri sector, which had been, struggling in the past, and that will be one of the focus area. What we see, government will, definitely like to balance out, but they have the kind of resources in this budget, and even from the fiscal deficit perspective, while the target was like 5.2%, but I think there's a now more and more of a discussion that it could be more like kind of a 4.9% kind of a fiscal deficit target what they can do. So there's more fiscal consolidation which they can do with the kind of resources which they have. So I think that's one of the very positive aspect. The other aspect is that street has been very jittery on the capital gains tax perspective. I think from the long term capital gains perspective, there could be an increase in the duration of what is being talked about, so that different assets, be it real estate, debt, and equity, they have kind of similar kind of a duration. The other aspect is in terms of the F&O market, where there has been a very kind of risk perception increase from the government side. What could be the stance in terms of the STT increase? That could be one of the stance, I think, which could come in to reduce the risk from the retail investors perspective, where the speculative activity on the F&O size has increased significantly. The other aspect which street is going to watch very closely is the government's continued focus on the infrastructure spending or the capex spending. And what we are seeing is that the expectation of around 17 to 18% of growth in the capex is what is being factored in. That is what we are looking at. So government will continue to focus on infrastructure build up. There not be any kind of a reduction in that, because they have the resources. And where does this money actually go into? This goes into defense, roads, railways, and water. These are the four largest sectors where the money actually gets spent. So I think these are the main areas what we are looking at from the government's perspective. Net net, I think from the market perspective also, it should not be that negative. But from investments, capex perspective, and consumption perspective, there will be definitely positives which we'll see in the budget.
Okay. Now let's come a little bit to understand about your own fund, sir, to have all our viewers, larger audiences also understand bit more about the fund that you manage, and what is the clear focus, the strategy also that you are employing here. DSP India Tiger Fund is something that you manage. Remember, the fund started on June of 11th, 2004. So it's 20 years that we've actually seen this fund in operation. There is a CAGR return of 19.22% since inception that we've actually seen. There is a total AUM that you manage of 4,896 odd crore rupees. Some of the top equity holdings, we pen down that, and probably you can let us know if there is any change in that. NTPC, Larsen and Toubro, Kirloskar Oil Engines, Siemens Limited, Bharti Airtel, Kalpataru Power Projects, Coal India, Polycab, Apar Industries and Hindustan Aeronautics are some of your top equity holdings right here. Let's understand now a little bit from you, sir. What is the kind of investment philosophy that you have with which you manage this fund, and within the current market move that we've seen of late, have you done any changes of late to this?
Yeah. So if you look at DSP India Tiger Fund, this is the Infrastructure Growth and Economic Reforms Fund. So it's a thematic fund. It is not a sectoral fund. That is what we are trying to highlight to the retail investors, that you have to be very careful about when you are investing, what is a sectoral fund and what is a thematic fund. So it means that within this thematic fund we have multiple sectors which are getting included, which helps a fund manager more room at these point of times and extremes of the market to actually allocate the weights to some of the sectors where you could see some value and move around the weights. Because if you are a sectoral fund, you have a very limited set of companies where you can invest, and at extreme points of the market you will not have any kind of a room to actually manage that kind of a risk, and bring in stocks which can actually continue to give your performance in terms of the return in the fund. The other aspect is when you look at the top holdings. So here our thought process has been that some of the key sectors like power is a sector where we see that there's a very long runway. Definitely, manufacturing is one of the sector which is picking up in a big way, and what we are seeing is that manufacturing as a percentage of GDP will rise from currently 14.5% to almost around 21% by the end of this decade, which is going to create massive opportunities for multiple sectors and the companies. And these companies are generally in the small and the mid cap space, and have a good runway for growth. So when we see DSP Tiger Fund, what it doesn't invest in is financials, consumer, IT, and pharma. But rest of the core sectors of the economy, be it manufacturing, cement, construction, telecom, oil and gas, these are the core sectors where we invest in. And that is why it gives us a good runway for participating in this entire journey for the next 5 to 8 years. What we are seeing is that from the cycle perspective, what we see is that last 5 years the government has been focused in terms of large ticket reforms. Our whole thought process is that next 5 years are going to be about execution. And I think we are meeting at the right time when we are going to see this, continuity of the government and continuity of the policies, whatever they have framed in the last 1.5, 2 years, which will give us a good runway from these companies' perspective in terms of participating in these opportunities. The private sector capex, which had been absent for last 10 years, now what we could see is that could see probably a pickup coming in from next financial year, FY26. So I think these are the factors what we are monitoring on a regular basis. But from our holdings perspective, you can see that we own quite a lot of stocks in the power, in the infra space, in the manufacturing sector. But we have been also very, actively managing in terms of, reducing our weights from the, defense sector, where we have brought it down from the peak 18% weight to almost around 5 to 6% weight cumulatively across all stocks. Some of the other stocks where we have seen the valuations are re-rated, so we have trimmed our positions or exited those stocks. And off late, we have started finding a lot of value in the large cap names where we have increased our weights. And I think those names are giving us very good opportunity at this point of time when the market looks frothy in the smaller and the mid cap space.
This is exactly what I was wanting to come to, sir. Large caps versus mid and the small cap space, and how should investors be now focused towards these two spaces particularly? Do you get that confidence that the underperformers of the recent past, the large cap banking names, the large cap IT names. These are the stocks that could perhaps come back into flavor, and it is now time probably to shift out some of the money from the small caps and the mid caps towards large caps for all our viewers.
Yeah, so I think it is also going to be very sector specific, Sakshi,
Okay.
because here, definitely, like you talked about financials, this sector has underperformed for like almost 4 years now. And that is where, as a fund house, we have been highlighting that there's definitely a lot of value which is there. And these are again, large cap, private banks, which are offering, pretty good value. And what we are seeing is that even in the financial space now, it has evolved very significantly, where you don't have only banks, but even NBFCs, capital market plays, the insurance. So this is a huge basket of opportunity which is there in this segment, which was not existing maybe 5 years back, and that is giving opportunity to the investors to participate in multiple ways in the financial sector. And I think there could be certain sectors where investors would have taken tactical call, maybe in the IT sector or the consumer sector. So you have to be very sector specific and stock specific, where you take a call that definitely for the next 3 to 5 years runway, these some of these segments can have a pretty good run up. And I think financials definitely fits that, because of the kind of valuations, kind of underperformance it has gone through. And in these kind of markets, when their market valuations are extreme, it is being pushed because of extreme liquidity. It makes sense to book profits in some of the small and the mid cap names and allocate it to the larger cap names, or even to some of the large cap mutual fund portfolios.
Okay, got that. Well, we'll also speak a little bit about your sectoral holdings as well. Like you pointed out, more infra construction play, that's what you're focused on. I wanted to ask you on the consumer durables aspect, which is still the lower holding when you compare with the others at this point in time. Why I'm asking this is, sir, again, from the budget perspective, there is a lot of talk about how the government could probably be focused on extending extra money or put extra money in the hands of people, and therefore consumption theme could be coming back, be it the rural recovery or the consumption as a large. Do you think consumption and consumer durable space will have enough and more opportunities from here on?
Yeah, so when you look at this, consumption space and consumer durables, so there's a wide basket of consumer electricals, consumer durables as a segment. And some of these categories, be it refs, washing machines, they had been struggling because one, the entry level customer was not there in the market. Now what we are seeing is that there is a sudden one, definitely pushed by a very harsh summer. There has been a pickup in some of these categories. But like you're rightly saying, if there's a push in the budget to drive the consumption, some of these categories could start coming back after 2 to 3 years of very weak period. There was a immense pricing pressure in these segments, and what we are seeing is that now the companies have started taking price hikes, which is again a very important indicator that as they are seeing the underlying demand improving, they are able to pass on some of the price increases. So there's more confidence coming in that these categories should start coming back. Even the festive season, there should be more traction which should be coming in. But overall, consumer electricals durable sector which had been underperforming, I think the time has come that some of these categories, even from the entry level perspective, have started showing some signs of traction. We have to now see post budget how the festive season pans out. And additionally, what we are seeing is now when you look at even from the real estate perspective, now most of the real estate players are now busy in terms of the launches. And as this pipeline, starts getting delivered, built, there'll be, building materials also as a segment will start picking up, which could have a runway for next 2 to 3 years. So I think we consider this as a complete, basket in terms of, housing, which gets, then, driving the consumer electricals, durables, and building materials, all these three spaces together. And I think that is kind of, getting ready over there to drive this for the next 2 to 3 years.
All right. Well, on that note, thank you so much, Mr. Singh, for sparing your time for us on Business Today Television, helping our viewers really understand the 360-degree view of how to really approach the market scenario at this point, the key themes, your own sectoral allocation strategy with which you're approaching the markets at this point in time, and of course, your own expectations from the upcoming union budget. Truly a pleasure to host you with us, and the markets are again rallying sharply, newer records being taken place. And right now, if you look at the Nifty, it's trading at 24,550 near those record high levels, 230 points higher, buzzing very, very strongly in trade. Viewers, we'll continue to get you such special conversation throughout the course of the day. So stay tuned on Business Today Television so that you know where exactly should you be putting in your money in the markets to take maximum profits. Thank you so much.